If you are a freelancer earning six figures and you are tired of writing massive tax checks every quarter, there is a strategy that millions of real estate investors use to legally reduce their tax bill. And freelancers are actually in a better position to take advantage of it than most W-2 employees. Today, we are breaking down exactly how buying a rental property can reduce your freelance tax bill, with real numbers using 2026 tax rules. We will cover depreciation, bonus depreciation, the rental loss allowance, cost segregation, and why your freelance income gives you a unique advantage. Welcome to the Freelancer's Wealth Blueprint. Subscribe for tax and wealth building strategies designed for self-employed professionals. Before we jump in, this is not financial advice. Real estate investing involves real risk. Always consult a CPA and financial advisor before making investment decisions. Let us start with why freelancers pay so much in taxes in the first place. If you earn $100,000 in net freelance income in 2026, here is what happens. You owe self-employment tax of 15.3% on 92.35% of that income. That is roughly $14,130 just in self-employment tax before a single dollar of income tax. Then you have federal income tax on top of that. After the standard deduction of $16,100 for a single filer and the QBI deduction of 20% on your qualified business income, your federal income tax adds another significant chunk. You could easily owe $25,000 to $30,000 combined in federal taxes alone. That is painful. Now let us talk about how rental property changes this picture. The single most powerful tax benefit of rental real estate is depreciation. The IRS allows you to deduct the cost of a residential rental property over 27.5 years, even though the property may actually be increasing in value. This is a paper loss. You are deducting an expense you never actually paid out of pocket in that year. Here is how it works. Say you buy a rental property for $250,000. The land is worth $50,000 and the building is worth $200,000. You can only depreciate the building, not the land. So you take $200,000 divided by 27.5 years, and you get $7,273 per year in depreciation. That is a $7,273 deduction every year for 27.5 years, reducing your taxable income without reducing your actual cash flow. If your rental property breaks even on cash flow, meaning rent covers the mortgage, insurance, taxes, and maintenance, you still get this $7,173 tax deduction. Now here is where it gets even better for freelancers. Under the passive activity loss rules, rental real estate is classified as passive income. Normally, passive losses can only offset passive income. But the IRS has a special exception for rental real estate. If you actively participate in managing your rental property, meaning you approve tenants, set rents, and make management decisions, you can deduct up to $25,000 in rental losses against your non-passive income. That includes your freelance income. This $25,000 allowance is available in full if your adjusted gross income is $100,000 or less. It phases out by $1 for every $2 your AGI exceeds $100,000, disappearing completely at a $150,000 AGI. For a freelancer earning $100,000, this is right at the sweet spot. And here is a planning tip. If your income is slightly above $100,000, you can use solo 401k contributions and the QBI deduction to reduce your AGI below the threshold. A $23,500 solo 401k employee contribution alone drops your AGI significantly. Now, let us talk about bonus depreciation, which was restored to 100% under the One Big Beautiful Bill Act. Bonus depreciation does not apply to the building structure itself. The building still depreciates over 27.5 years. But it does apply to personal property components inside the rental, things like appliances, carpeting, light fixtures, window treatments, and certain land improvements like fencing and paving. These items have shorter recovery periods of 5, 7, or 15 years. And with 100% bonus depreciation, you can deduct their entire cost in the first year you place them in service. This is where a cost segregation study becomes incredibly valuable. A cost segregation study is performed by an engineer or specialized firm that walks through your property and reclassifies building components into shorter depreciation categories. For example, certain electrical systems, plumbing fixtures, flooring, and cabinetry might be reclassified from 27.5-year property to 5-year or 7-year property. With bonus depreciation at 100%, those reclassified components can be deducted entirely in year 1. Let me show you how this works with real numbers. You buy that $250,000 rental property. A cost segregation study identifies $40,000 worth of components that qualify for bonus depreciation. In year 1, instead of just the $7,273 in straight-line depreciation on the building, you also get a $40,000 bonus depreciation deduction on those components. Your total first-year depreciation deduction is now $47,273. Even after the $25,000 rental loss limitation against your freelance income, you are carrying forward the excess for future years. And that $25,000 deduction against your $100,000 freelance income saves you real money. At a combined marginal rate of roughly 34% when you factor in income tax and the self-employment tax deduction benefit, that is approximately $8,500 in tax savings in year 1 from the rental loss allowance alone. Now, let us talk about why freelancers have a unique advantage in real estate investing. First, schedule flexibility. You can visit properties, meet contractors, and manage tenants during weekdays when W-2 employees are at work. This flexibility helps you qualify as an active participant in the rental, which unlocks that $25,000 loss allowance. Second, loan qualification. Many freelancers worry they cannot get a mortgage, but lenders look at your Schedule C net income averaged over 2 years. If you have been freelancing for 2 or more years with consistent income, you can absolutely qualify. Your QBI deduction does not reduce the income lenders use for qualification purposes. Third, your freelance income is already subject to self-employment tax. The rental income you eventually earn is not. Rental income is passive and exempt from the 15.3% self-employment tax. As you build your rental portfolio, you are shifting income from the highest taxed category to one of the lowest. A few important warnings. Depreciation is not free. When you sell the property, you will owe depreciation recapture tax at up to 25% on the depreciation you claimed. Real estate is illiquid. You cannot sell a property as easily as selling stocks. Maintenance costs, vacancies, and problem tenants are real. And the $25,000 rental loss allowance phases out above $100,000 AGI. Your action steps. Run the numbers on your current tax situation. Determine if your AGI qualifies for the rental loss allowance. If you buy a property, get a cost segregation study to maximize first-year deductions. Work with a CPA who understands both self-employment tax and real estate tax strategies. And start with one property before scaling up. Real estate is one of the most powerful tax reduction tools available to freelancers. Combined with your solo 401k, QBI deduction, and other strategies we cover on this channel, you can dramatically reduce what you owe every year. Subscribe for more freelancer tax and wealth building strategies. See you in the next one. This content is for educational purposes only and does not constitute tax, financial, or investment advice. Consult qualified professionals for guidance specific to your situation.